Hey, everyone, and thanks for joining us for Cherry Becker's 2023 Tax Credits and Incentives two-day virtual conference. My name is Marty Kerman. I'm a strategic tax partner in the Tax Credits Incentives Advisory Group. Our session today is centered around the advantages of pursuing the Research Development Tax Credit, ERC Section 41. We're also going to cover quite a bit around the Employee Retention Credit in the reverse order, actually. We're going to hit ERC first. Each session today and yesterday is led by professionals within the group of Tax Credits Incentives Advisory. We hope you're able to join all the sessions. And I want to introduce some of my colleagues who work with me. Attending and presenting with me today is Dan Mennel, who's a partner in our group, Carolyn Smith, who's a director in our group, and Vivian Kors, who's also a director in our group. And each of us are going to take certain parts of this presentation. So here's what's going to happen. We're going to cover ERC first, then we're going to get into the R&D tax credit and talk a bit about Tax Credits Incentives Advisory and our process and how it's a bit differentiated, I would say, from some other mid-tier firms, but also from a lot of what we're going to focus on today is the differences between working with an accounting firm and some of the consultancies out there, especially on the ERC side, what's known as an ERC mill, which we'll talk about quite a bit. But yeah, we're going to make it a little bit, we're going to talk a bit amongst ourselves as we go through this stuff. So let's move to the next one. All right, cool. Tax Credits Incentives Advisory, just a little bit on our group. I want to get through some of those quickly, but of course, the entire point of the group, we're focused on federal and state permanent and temporary benefits. So to the extent a company is investing in R&D, putting up a building, hiring, or moving to a different state, building a building, whatever activity there may be, we try to investigate that, kick the tires on it a bit, and see what incentives may be available for that. And then we can move to the next slide. That's all part of our broader approach, not just Tax Credits Incentives Advisory, but we're part of strategic tax. So we are doing our best lately to focus on yes, the credits and incentive side of things, but also what there may be from a sales tax perspective or what there may be from an international perspective. Basically getting into working with a lot of our clients to, as mentioned, kind of kick the tires, but really give a full review of the tax position from a federal and state perspective and where we may be able to find immediate opportunities, some of which may yield permanent benefits that may pay for certain other services that may be necessary from a client compliance perspective. That's what we're doing, but let's move on. That talks exactly about what strategic tax advisory is, which is focused on international credits and incentives, state and local. And then also we have a really well-regarded new markets tax credit group, especially to the extent you have companies looking to do site selection, which combined with some other state and federal incentives, we are quite adapted to do it. But let's get to the point at hand today, which is, well, let's start with the polling question. How did you hear about it? Did you get it? Did you hear about it from a Cherry Becker tax advisor, an email from Cherry Becker, friend or colleague, Cherry Becker alumni, or from a social media post? And we'll give it a moment for everybody to respond. And then as soon as that moment has passed, however long it may be, we shall come back to you and give you an answer and show you how the poll came out. But we want to make sure everybody gets their CPE credit today. And while we're doing this really fast, Dan, Carolyn, and Vivian, why don't you give a bit of background on yourselves, where you're based, and then we'll move on.
Yeah, happy to do that. I'll jump in. I sit on the West Coast in San Jose, California. Been practicing and focused on TCA, specialty tax solutions, for 20 plus years. Excited to be part of the team. Been with the firm for 2 years. Prior to that, 10 plus years in Big Four. Maybe I'll pass off to Carolyn. Thank you.
Why don't we address the polling results and then next poll? I'll introduce myself.
Very good. Number one, emails from Cherry Becker. That means we're doing our job the right way. So good stuff. And if a friend recommended this, are they really a friend? I don't know. We'll see. A colleague, yes. But this is good stuff. All right, everybody. Thanks. Carol, why don't you finish a little bit about where you're based and what your focus is, and then Vivian too, and then we'll move on.
Sure. Carolyn Smith Driscoll. I sit in Orange County, California, so Southern California. I've been doing this for a very, very, very long time. I've been with Cherry Becker a year and really happy to be here. And thank you for joining us for this information session.
My name is Vivian. I'm a director sitting in New Jersey, although I wish I was in Southern California because the weather is fantastic there. But focused mainly on research and development tax credits as well as 174. And I've been with Cherry Bekaert almost 2 years.
All right, good stuff. So let's move on. So one of the points we're going to talk about today is the benefits of working, I think, across the board with an accounting firm, whether that be employee retention credits or R&D credits. When it comes to just holistically looking at a tax position that needs to be filed, whether that be something permanent like ERC and R&D, the benefits of working with an accounting firm who actually signs your return, as opposed to a third-party consultant who may give you a project and has to rely on somebody else signing the return, like the CPA firm in that context. It's much better to have all of that together. There's no white space between one position that a consultant may give and what the firm may be able to sign off on. We're going to get to a case later today that talks exactly about one of those, that issue, and how the CPA firm still got a little bit in trouble for it, and the taxpayer as well, due to the fact that you can't necessarily rely on a third-party consultant if they're not signing the return. So the other stuff being, there's a number of additional services beyond just looking in a vacuum at one thing. And then also the fee structures are generally more favorable for the clients from an overall pricing perspective. And it's not generally tied to a contingent fee arrangement, which tends to incentivize the provider to maybe find a credit bigger than maybe it should really be there. So let's move on.
And Marty, I want to just add a little bit to that. Do your homework regarding your provider, right? We all listen to the radio. We all read the news, going concern, all of that. Read as much as you can, especially with ERC. I know R&D, dirty dozen. Where is your provider going to be in a few years? If and when you're audited, are they going to be around and able to support you? Is there a prior history of the company? We're seeing with respect to ERC that a lot of these companies have incorporated very shortly after the CARES Act was implemented. So do your homework. If you are working with a third-party CPA, have them sit in on calls and ask the questions that you may not know to ask. So,
all right, we can move to the next and start talking about employee retention credit for real. Yeah, great. Thank you, Caroline. So the employee retention credit is one of the most talked about, heavily advertised, most both understood and misunderstood tax incentives that I have ever come across, due to the fact that it is so lucrative and the guidance was somewhat sparse when it came out during the CARES Act, and has evolved a bit since it originally was put into place. But just for a review, for those who don't know, or I'm sure you've heard about it on your commercials on TV and on the radio and on your podcast, but there are 4 separately calculated and separately determined employee retention credits. There is one for the time period of 2020, March 13th through the end of 2020, which is a refundable payroll tax credit. There are then 3 more for each of the first 3 quarters of 2021. This is the stuff you hear on the radio, like you can get up to $26,000 per employee if you qualify for this. I mean, sure, potentially, but absolutely maybe not as well. You may be able to entitled to less or nothing at all. It depends upon whether or not you, as an employer during COVID, and we can go to the next slide, during COVID, and I mean 20 through basically through the end of 2021, if you suffered some disruption or loss in customer base due to government orders being issued specific to COVID that caused a disruption in the marketplace. And you measure that in one of 2 ways. One, if it's the measurement of government orders basically cutting down your customer base, the government putting a stop on the economy a bit, and your gross receipts for the 2020 credit fall by more than 50% in any quarter of 20 compared to that same numbered quarter in 2019, that's an automatic qualification under what we call the gross receipts test. Now, there is another test called essentially what we call the government mandate test. It's basically, did you suffer a partial suspension due to the imposition of, basically due to the disruption of government orders on a more than nominal piece of your business. And so in this particular case, we look to find those companies or employers that had a COVID order that caused them to operate differently in a way that truly disrupted their business. And essentially what this employee retention credit is it's kind of a reward for keeping individuals employed during a time when you probably may not have had as much to do for them due to the fact that the government was putting some kind of stop on the economy. And so you're being rewarded really for that. Initially, you couldn't even claim it if you took a PPP loan. Later in 2020, they changed that rule so that companies could go back and retroactively apply to take it. And that kind of opened up the floodgates of both claims that were on amended returns and also just a number of taxpayers who could claim it. So what I've seen is that in 2020, the government mandate test is the test that is used more often to qualify an employer, because I would say that the government orders were more onerous and there was more uncertainty and companies were not quite adept at operating in the COVID environment. It was quite hard to hit a 50% decline in gross receipts, although we see it often. If we go to the next slide though, let's just say something else. On 2021, you only need to have a more than 20% decline. So if for the 2021 credit, I see that being more common under the gross receipts test if you truly qualify. What I have seen though, and you were right on that other slide, if you don't mind.
Sorry.
What I have seen though, is that again, we have to have a government order hitting a more than nominal portion of the business. What that really means in layman's terms is, and I'll put it in very simple terms, if you had a company that both manufactured cars and sold ice cream, and basically there was a mandate stopping them from selling ice cream on their like in-person dining, and that made 2% up of their company, but the rest of them were selling cars, that mandate on the ice cream shop doesn't stop everything else. So we need to look at the trader business at the company, and we need to determine whether or not that government order was actually having an impact on a more than nominal portion of the business. And we define more than nominal as basically making up gross receipts, and you measure back in 2019, if the gross receipts associated with the business were more than 10% of the business, or the hours spent by employees at that particular trader business made up more than 10% of what the business did. This has opened the floodgates, though, this concept of government orders and a more than nominal impact. And we'll talk a little bit more about it in a second, but what we have seen across the board is a number of ERC mills and consultancies telling companies that, you had to go to 2 meetings virtually as opposed to going to the office. There's no decline in gross receipts. You're automatically qualified. And I've seen that happen across the board for multiple quarters. And it's unfortunate because what they're doing is feeding the taxpayer sometimes a line of like what qualifies, and being a little overly simplistic on what the true requirements are, and then saying, well, we relied on the taxpayer's representation that they qualified, and then they perform a study, they don't sign the return, and then they may be gone in 2 years. So the whole point of this is really to talk a bit about what the IRS is doing, which we'll get to, but almost to just give you a bit of a warning. To the extent you're working with somebody who's not a CPA firm, who won't be signing your return, and if you're making a claim just on government orders causing some kind of suspension of your business or a supply chain disruption, which we'll get to in a moment, be wary and have your CPA look at it. And if they give a different opinion than the consultant, listen to the CPA, would be my thought.
And Marty, I want to add that on July 25th, final regs were issued that address the recapture of excess employment tax credits. So what that means is erroneous refunds are now subject to assessment, so penalties and interest. So they've upped the enforcement game.
All right.
Yeah, and I'll just add to that prior point that Marty made. We've been on a lot of calls together where we're looking and providing a second opinion and being more honest and conservative and sharing with our clients that, post a discussion they had with a ERC boutique firm, that you in fact don't qualify. So if you ever want a second opinion, these guys are experts and can help.
Yeah. And I wouldn't even say we're conservative. We do our best to analyze what is out there and try to be as close, try to be right, actually give you the right answer. If you don't qualify, we're not trying to sell you a project. And honestly, I think that should be the approach. But no, absolutely. Conservative by comparison, though, without a doubt, Dan, when you work against a boutique that tells somebody they qualify for everything. All right, so this is the 2021 rules. And I'm just going to talk a bit more about some of the changes in 21 that open it up a bit more. The gross receipts test was changed such that a company only has to have a more than 20% decline in gross receipts in any of the first 3 quarters of 2021 compared to the same quarters in 2019. It also opened it up to public colleges and universities and some hospitals as well, which it wasn't for 2020. So it really was open up to employers. And the other misnomer about this is it also applies to nonprofits as well. So it's important to know if you're a nonprofit, if you're an employer, even if you use a PEO and you don't file the 941s, you can file through your PEO as well. So it really was intended to keep people employed or reward employers for keeping people employed during a time when they suffered declines in gross receipts or were truly limited by government orders. Okay, we can move to the next. Okay, gross receipts. I'll just talk about this briefly, and I've rerun this because we need to be clear. When we're talking about what the decline is in revenues, the true test is gross receipts, and it's not just sales. It's also including things like dividends, interest, rents, royalties, and other income. And there is a little bit of a difference between the rules for gross receipts for taxable and tax exempt entities. Specifically speaking, when it comes to this other income line for the taxable entities, if you make a sale of assets, it's basically the difference between the basis and the sales proceeds would be the amount of gross receipts. From a tax exempt entity, not true. It's the entire gross proceeds. That's one little misnomer, which is not necessarily important for this, but the most important thing is we need to calculate gross receipts appropriately. There is a difference between taxable and tax exempt entities, and things like PPP funding, things like shuttered venue grants, restaurant revitalization funds are not counted in your gross receipts. So that was an unclear question at the beginning of this, and the IRS cleared that up in August of 2021. So why don't we move on? Qualified wages. Okay, so here's the deal. This is one of the more important points. There is enhanced employee retention credit for small employers versus large employers. And the definition of what a small employer is for the 2020 credit only, it's an employer who had basically 100 or fewer full-time employees on average, but that's measured back in 2019. For the 2021 credits, it's 500 or fewer full-time employees on average, measured back in 2019. Point being, for the 2021 credits, it was open to a lot more employers, 500 or fewer employees at the place as opposed to 100, to basically, if you qualify, include the wages you pay to every person, at least up to the first $10,000 in the credit generating period, multiplied by 70% or 50% in 2020, such that you're getting a credit on everybody you paid wages to. What we have seen for large employers, especially in 2020, who might not have gotten PPP funding, we've seen that you can actually only include, for a large employer, wages you pay to individuals who you kept on the payroll, but they didn't have work to do. It's not that they were coming to work and were less productive. It's really that they were being paid not to work, which can include amounts paid for healthcare expenses if you furlough someone, but really it's nothing more than those two things. And what I have seen some of the boutiques take the position on is that the amount of PTO taken by a person is treated as time not worked, which is specifically not, well, the IRS addresses that very clearly in its notices. And then I've seen the boutiques also say, well, we don't respect the IRS notices because it's not, holding guidance. Maybe true, but then they'll say like, and we'll talk about this, but we experience a supply chain disruption. That's only from the notices. That's not in the law. So they like to rely on the notices when they like to, and tell them that they're invalid when they don't. So I would just say, follow the IRS guidance. It's important in terms of how they're going to give you a clue in terms of how they're going to look at this stuff. Let's move on. Polling question 2. Do you think you may be eligible to claim the ERC, but have not filed for it yet? I'm gonna wait to see some responses here. Yeah, we'll give it a minute.
Marty, do you want to talk about the recent supply chain general legal advice memorandum, GLAM?
I'm happy to, but we have a slide on it in a minute. But I'll actually start on that. And I was
teaser.
that's good. Thank you. In 2020, when some of the original FAQs came out, the IRS indicated that for an essential business, meaning one designated by a state or local authority as one that government orders did not apply to, the IRS provided an example, both in the original FAQs and then later in Notice 2021-20, that if the essential business, which was not subject to a government order, had a supplier that was subject to a government order, basically causing a partial shutdown through like sort of a transference, by transferring that government order on the supplier, basically it would apply to the business itself. And I'll get to this polling question. Are you able to call it? Not yet 5-4? No. All right, good. Let's move on. This concept of a supply chain disruption is something that I'm sure the IRS regrets ever putting into an example, because it clearly did open up the ability for, I would say, some taxpayers who were truly disrupted due to government orders on the suppliers where they couldn't get supplies and they were an essential business, but they had to basically they had a partial shutdown due to the partial shutdown of the supplier. What we have seen though, however, is the boutiques and the ERC mills sort of run with this position and convince clients that, there were a number of supply chain disruptions out there. There were ships and ports. There was, you couldn't get chips, all this stuff. I read something in a newspaper that there was a supply chain disruption. That's not enough. What we know, and there were 5 examples provided by the IRS in this general legal memorandum that indicated a number of things. And here's sort of the rules of the road. Number 1, you have to, as a employer, if you're working with a supplier that you are claiming had a supply chain disruption, you need to identify the very specific government order that was imposed upon that supplier. And 2, the duration of your disruption cannot last any longer than the time that that particular government order was in place. 3, if you had enough inventory on hand to not necessarily suffer too disruptive of an impact due to your supplier not being able to get you anything, then you didn't have a partial shutdown because you had things purchased ahead of time. Carolyn, what am I missing? There's a few other things.
Just basically a partial suspension on a supplier could be the path to eligibility if it's a result of a government order, but it must result in a partial suspension of business for the employer. So the company claiming the credit. So that's the connection, the government order, the supply chain disruption, and then really identifying the partial suspension on the employer.
And we've done this supply chain analysis for a number of companies successfully. And the technical documentation is quite robust because you need to identify who the supplier is, where they're located, how long that order was in place, and then find internal financial information to indicate that the supply chain disruption was on a more than nominal portion of the business, that they couldn't find another supplier to supply, and that there was some kind of a lead time change in terms of how quickly they could fulfill orders based on what they were importing or receiving. So and this is not to say it's not a valid position. It is. We've done it successfully, and we are doing it currently for a number of clients right now. But I feel a little bad for some of the clients I've seen where we have to review the work, and some provider will indicate that there was a CDC guidance or some kind of OSHA general guideline that pre-existed before COVID as allowing them to claim both a partial suspension either on themselves or due to a supply chain disruption. So just watch out for that. It's a really good position. It really, I think, is fair to taxpayers to be able to claim in that case, but you really have to do your homework. And the IRS, I think, has helped out, and they've provided guidance here under this GLAM. This thing here says new and updated IRS FAQs. Actually, for the most part, the FAQs are treated as historical documents for purposes of this analysis. So it's also not quite exactly what you would call guiding or authoritative law for this purpose, but there certainly has been a call recently, and we've seen this recently in a Ways and Means Committee hearing, that some additional guidance would certainly be helpful for purposes of reliance. We'll see what we get there. The next item that's sort of a hot topic in this area is the concept of private equity ownership. Companies have to look at their both gross receipts and their employee counts on an overall control group basis. When we look at the PE ownership, you don't necessarily have to include all the portfolio companies together, because the PE fund owning it is 9 times out of 10 in most structures treated as a passive investment vehicle and not an active trader business, which may break aggregation among all the portfolio companies. So we work with a lot of both funds and portfolio companies who have looked at each operating entity separately, such that they could claim the multiple employee retention credits or none at some. Again, some of the marketing by the ERC mills, watch out for anybody who says you're going to get $26,000 per employee and who charges on a contingent basis, but really watch out for the ones who tell you, we can tell you if you're qualified in 5 minutes. Probably not. You can't. And we really need to spend time on this. There's so much money that's available and should be received by employers who qualify for this. It's just important that you don't work with somebody who thinks they can get you there in 5 minutes. The other thing that we're working with and coming into contact a lot is on acquisitions of trades or businesses, especially for those both who have claimed and who haven't. The kind of the question of whose credit is it? And so in the context of a company that purchased a company under a stock acquisition, generally speaking, the EIN survives and the purchaser can claim. Under the asset acquisition perspective, generally it stays with the former owner. If ever needed in the context of acquisitions or dispositions of businesses, we're happy to talk through that. The other thing as well, and Carolyn and I are doing monthly discussions on the employee retention credit, the statute of limitations for the 2020 credit expires April of 2024, April 15th specifically. For the 3 2021 credits, it does not technically expire until April 15th of 2025. So this is so heavily marketed. More people are learning about it. The IRS is going to receive more and more claims for 21 through April 15th, 2025. I've seen some testimony. I've heard some testimony that I viewed, and there's been somewhat of a call from a few to shorten the time to apply for this. So if you're looking at it, I would suggest you look sooner than later. There's been a lot of time to look at it, but I don't think the filing time will change. I would be surprised if legislative action took place to have this take place in time. But if you're looking at 21, I would look at it sooner rather than later and just decide whether you do or don't qualify. Why don't we move to the next? All right. This is really just a slide on supply chain disruptions, and these will be available later, but it's exactly what I was talking about before, that you need to identify who the supplier is, show that it was truly disruptive upon you, identify the specific government orders on the supplier. And you can't just sort of say, you know, I was reading about supply chain disruptions during this time. I think the IRS will buy off on that if they review this. Let's move on. ERC pitfalls, exactly the same thing I was just talking about. We need to identify disruptions that are specifically related to government orders. And then again, the ERC scams and the warning signs. The unsolicited calls are quite annoying. We've all seen those. We've had Robot Deb or Robot Hazel or Robot Heather give us a call and let us know that, like, we may qualify. Generally speaking, I don't suggest you work with any company that has ERC in its name or that charges on a contingent fee. We're more than happy to look at anything that may be there. Okay, and let's move to the next. Great. So now we're going to move on to the R&D tax.
Before we jump to R&D, I know we got 2 questions in the Q&A that are kind of around ERC. So what about companies that were started during COVID? What is the test for that, and how much are they eligible for?
Okay, it depends when they were started during COVID. So if they were started after February, well, in the middle of February 2020 or thereafter, and they don't have average gross receipts of $1 million or more, there's a recovery startup credit specific to startup companies for quarters 3 of 2021 that can max out at $50,000 for each of those first 2 quarters, for each of those quarters 3 and 4. So the max credit is $100,000. It's still 70% of the first $10,000. paid to employees in each of those quarters during that time, but if you can't get more than $50,000. Technically speaking, though, you could also use a government order to say that you were disrupted for periods prior to that, between the time of starting and those quarters 3 and 4. The interesting thing about that is there's no other quarter 4 ERC. That's the only one. Otherwise, the ERC ends in quarter 3. What's the other question?
Is the $10,000 limit for an annual per employee cap?
It is not. It is during the period of the employee retention credit period, which is one of them is the 2020 credit is March 13th, 2020 through December 31st, 2020. And then the next 3 are commensurate with quarter 1, quarter 2, and quarter 3 of 21. So 10 grand in quarter 1, 21, another 10 grand in quarter 2, and another 10 grand in quarter 3. So it's 4 $10,000 periods, 1 subject to a 50% credit, 3 subject to a 70% credit.
And then we just got one in. How soon would IRS begin to audit the ERC credit?
Oh God, they have been doing that.
They are. They are.
They're doing it currently. They have different processes. Everything is subject to examination. What they have the ability to do for those companies that have no gross receipts decline, they can run a quick check to see if a company's been growing and see if that makes sense for them to claim. Yeah, but what also this questioner may want to know as well is, after you file your claim, how long will it take you to get the money back too? And that is probably anywhere right now from 4 months to a year. And there's not necessarily a rhyme or rhythm as to why and that is happening in terms of that different, but there was such a backlog. I'm seeing that the newer ones going in are getting answered much more quickly than the older ones that still have not been answered. And so the IRS is looking at this. There is a standard information document request that they have issued for ERC claims, and our deliverables are all tailored to address those. But in short, it's what were your gross receipts? Were you part of a control group? What were the government orders and how long were they? And how can you show me that it was actually on a more than nominal piece of business? And did you double dip with PPP as well?
Mhm.
That's all perfectly fair. So I know we're getting more and more questions on ERC. I think people are excited that we're answering them live, but I do want to make sure we're talking about R&D credits. So maybe we can come back to those at the end if we have time.
That's great.
Let's do it.
Thanks, Vivian. Marty, Carolyn, great job on ERC. Appreciate that. So let's do our first polling question. Have you claimed the R&D credit in the past? I'll give you guys a minute or so to answer that question. While we wait, I'll just say one of the reoccurring themes from the ERC portion of this presentation to the R&D is buyer beware a little bit on boutique firms. Several of us on this call, including Carolyn and I, have been very focused on helping clients, new clients to the firm who have used boutique firms and really paid a pretty hefty fee and got a deliverable that left them very challenged to answer IRS like fundamental questions. And so, it's a very much a similar fact pattern or warning that Marty shared on ERC, that be careful on boutique firms, and really that's the advantage of working with a firm that is cross-functional audit tax and full tax compliance.
But don't be afraid of the credits at all. They're really lucrative. You should be claiming them. It's really like something we should be going after, but absolutely right then.
Yeah, so the response to this is great to see, which means a lot of people on this call, 105 have not claimed their R&D credit. This is consistent with some of the slides we'll cover later on about how many taxpayers are actually eligible for R&D, but don't take it. So for most of you who indicate you haven't taken the R&D credit in the past, this will be informational and helpful. For those of you that have done the R&D credit and you're experts, you'll be getting your CPE for R&D 101 here. But this is just a high-level overview on the R&D credit. It's often overlooked and misunderstood. There's a lot of industries that are eligible for the R&D credit that don't think about it because you don't have people running around in white lab coats. It is intended to be very broad, and we've helped taxpayers with some very large R&D credits in manufacturing, forestry. I mean, a lot of industries that you don't necessarily think of as core R&D, and they or do well on the exam. You just have to, again, work with a reputable firm that knows where to focus and what to focus on, which is part of the next slides we'll get into. So from the perspective of a kind of overview on the federal and state, more than 40 states follow and have a R&D credit. A lot of those credits are very nuanced in what is eligible, how you apply for it. And we have a dedicated team that has a very state-centric or state-focused perspective on those rules. And we make sure we hit those deadlines, and we know when there's a pool and that pool may evaporate. So, time is of the essence. From the perspective of attribution or the use of credits, the credits, if you are in an NOL position, can be carried forward. Often, even if you go through an M&A transaction, those credits have a value to a future buyer. So even if you are in a business that you're not sure if they perform R&D, you think you do, but you have an M&A transaction, or you're thinking of selling your business, that value of the R&D credits, even in a carry forward, has value to a future buyer. So it's worthwhile looking into it. Yeah, we'll get into the two methods in a little bit. Thank you, Carolyn, for advancing. This is the 4-part test. So this is the critical criteria that we always go through with calls, client calls when we kick things off, to understand the vernacular of a business component versus a project. Business component is the IRS vernacular for how you look at a project. So we go through and we look, do your projects meet this criteria? And it's an and test. They need to meet all of these. Are you attempting to improve the function, performance, reliability, or quality of a product or a process? Is it technological in nature? Does it rely on the core sciences as opposed to just taste, personal preference? A critical one is uncertainty, and that ties into experimentation. Here, we're trying to understand what is your technical uncertainty, and what was the capability to improve method or appropriateness of design. So when we document this, when we cover it, the reason they go hand in hand is that if you are going through a process of experimentation, that generally lends itself to the fact that there's uncertainty. So those two are really closely tied. This is by far, where you make your money in working with an experienced firm, because these two tests are where, if you look at case law, a lot of times clients fall short to really thoroughly covering this and articulating why each business component or each project you're qualifying meet the 4-part test. So this is a summary of some of the non-qualified activities. Like anything, or particularly in R&D credits, there's a lot of gray areas and there's nuances where almost any one of these we could say yes, but. So research after commercial production, adaptation, funding. When we scope and look at any client, we immediately look for things like funding. We look at your contracts. We want to understand, do you have risk and rights? We confirm where the location of your employees are and your contractors, because of that foreign research component. Quality control. We again make sure that once, we look at R&D from a continuum, from the time R&D starts to the time R&D ends. And within that range is when you are eligible. So generally speaking, once you get to that end, and that's why this sits to the far right, when you get to production, generally R&D ends at that point. So for internal use software, there's 3 additional tests. There's caveats to this as well as to what is and is not internal use software. If you can make the assertion based on the way your platform works, that it meets some of the exceptions, then you don't have to meet these additional tests. But the first one is a significant economic risk. And again, on each one of these, we document that you meet this if you fall into internal use software. And this is really meant for like back office software. If you were developing an accounting platform that you're using internally and just internally, it's not offered, it's not in a platform where your clients can see through to the platform, then you have to meet these tests. Is it innovative? And you have to compare that to what's in the marketplace, and is it commercially unavailable. And then often we get into fact patterns of, why clients are developing something for internal use, because, maybe it's cost prohibitive of the available platform in the marketplace.
And on the innovation test, I just want to highlight, we want to be able to document that it is a measurable improvement. So we want to make sure we're gathering metrics as to how, by developing your own internal use software, did your company benefit from that. So maybe it's processing speed, maybe it's generating this report that used to be manual and it takes a whole month to generate, now it takes a day, that sort of deal. So we want to make sure we're getting a measurable improvement.
Yeah, thanks, Vivian. This is definitely an area of heightened scrutiny from the IRS. So we really focus on buttoning down and having a good, solid argument for why you qualify. This gets into the 3 areas that qualify for the credit. So you have wages, you have supplies and contractors. From a wage perspective, we use box 1 W-2 wages. We always try to leverage time tracking information. The reason for that is we know, we put ourselves in the client's shoes. One of the most frustrating points between a tax director and a technology team at a company is, are you being duplicative? Are you kind of wasting the time of our engineers? So we really are focused on saying, no, we're not wasting the time. We do everything we can to leverage time tracking. That doesn't always mean that time tracking is everything that we need. We often need to supplement that with additional detail to really have a solid position around activities. And again, we're focused on IRS vernacular, which is often not the intended purpose of time tracking. We have a survey. Our survey is very focused on being IRS ready. It allocates time to business component and activity so that we can meet the standard IDR, and that helps us get through exams. It's also a selling point when we review the work. Even I've on occasion reviewed the work of Big Four where the survey doesn't have that allocation, and then the client's getting IDRs they can't respond to. And it's a point of frustration, like, why did I pay so much money for this study and get charged for rework when really shouldn't that have been done on my original study? And the answer is yes. And Vivian and this team spent a lot of time making a really solid survey that accomplishes that. From a supply perspective, again, we look at R&D from the perspective of your continuum. When does R&D start? Which is really when marketing gets involved and they're creating a marketing requirements document about what a future version product needs to look like, all the way to when you're ready to put something into production. So supplies that are consumed within that time frame are what are eligible. In addition to that, prototypes are included here. This is also a very contentious area with the IRS where you want to work with someone who knows what they're doing. The people on this call have been focused on R&D for 20 years, except for Vivian, who's only 30, and very focused on what costs are eligible and why as it relates to prototypes. The aerospace industry lobbied hard on this, and so most of the guidance is very aerospace centric, but it's fairly easy to have positions that sort of mirror that. Cloud computing expenses.
Oh, sorry.
That's all right. Carolyn said she was going to advance the slides if I bored her at any point. So I was boring Carolyn. I'll try to add some pep to my talk. So cloud computing. So this is an interesting one. I think the original back in the day in the 80s when the R&D credit rules were written, it was, Big Blue and IBM using a supercomputer. Now with computing technology, a lot of that is in a SaaS platform and a lot of our clients use AWS and other platforms where you have to bifurcate. So you have to look at, again, looking at your R&D continuum. If you're incurring cost with a company like AWS and you're hosting, were you hosting and using that time specifically for R&D? And then if so, you want to we talk to the subject matter experts that are familiar with that bifurcation, and we document that. So this isn't an all or end. You should be reasonable, and because cloud computing expenses can be very high, and not all of it is eligible for R&D. But a solid argument, often is with many of our clients, it can be above 50%, just depending on the nature of your spend during that year. Contract research.
Sorry, I'm moving you along. I want to make sure we have time for everything.
Okay. Calculating the R&D credit. Okay, two methods. Again, this maybe we're moving from R&D 101 to 202. Here we're jumping into the methods, the approaches you can take. The traditional method, often called RRC, regular research credit, versus ASC. The bottom line on this, just to keep things flowing, is that we look at both and we make sure that we're looking at the one that is most advantageous to you, and that often considers the availability of solid information. That you can see in bullet 1 under the RRC, you're looking back often to early years, 84 to 88, an arbitrary time frame the IRS selected, and the ability to get information for clients that existed back that far is often difficult. So we often will make the ASC determination because it relies on a more recent time frame. Vivian, did you have
And
something
there
to
are
add?
also startup rules. So a lot of the newer companies, don't be afraid. We definitely look at different ways to calculate to make sure we're maximizing the credit.
Yeah, and this slide is just a basic side-by-side analysis of the two methods, so you can see what are the criteria and how they're being applied. In this case, the 3% fixed base percentage in the traditional calc, which I called, RRC, that's the same, yielded a higher credit. And in this case, in all likelihood, the 3% is relying on startup rules. So depending on when your company started, and that drives the time frame that you use in that fixed base percentage. Anything else anyone wants to add on that slide? Otherwise, I'll turn it over to Vivian to jump into our
Yeah.
survey process.
I'm going to add something, but that's going to speed stuff up later. And the whole point just here being that there's no need to have time tracking or anything. Your books and records don't have to necessarily reflect how you basically track your R&D. What we have are tools to allow us to do it in a way that would treat it the same way as if you did have time tracking. In the end, the output will look exactly as if. And so within our firm, other firms have done this, and we have now as well, is develop our own tool, because a lot of times you have to do these surveys and we don't want them to be time consuming for our customers, our clients. And so we have developed, basically utilize technology to develop processes to make that more advanced, easier. Vivian, take it away.
So basically, how do we best establish nexus between your qualifying activities to your qualifying dollars? That's the whole process of this web-based tool, is to be able to allow for that. It clearly gives the project managers, in many of the cases would be maybe the controller or the tax director of a company, a snapshot of what's outstanding or what's currently being calculated. It gives you kind of by state how much expenses, qualifying expenses are generated from each of those states. And then also, in addition to just establishing the quantitative side, our web-based tool also does a lot of the qualitative documentation. So you can securely upload, provide any of the information that showcases how your projects or how your business components meet the 4-part test. And that's all done in this web-based tool that can securely and efficiently gather everything that we need.
Very good.
Now, with that said, I know we're on poll 4. Everybody wants their CPEs.
Let's do two things at once. Let's do two things at once. Okay.
Yeah.
Have you been informed about the R&D capitalization requirements that are required beginning in 2022? We're going to do 3 things. If you guys can answer that question, yes or no. 2, that's an advertisement for the thing that we have coming up after this, which I think is the thing probably most people are interested when it comes to R&D, which is are the new capitalization requirements that hit in 22. Not that new, though. They actually were put in law in 2017. 3, what's another question on the chat that we haven't answered yet, Vivian, while people are answering?
Oh, great question. Okay, so are patent filings useful in providing R&D activities? Absolutely.
You go for it. Yeah, absolutely. It's like almost like prima facie evidence that you have R&D. It's also a 174 expense that you have to capitalize and can no longer deduct. So good and bad. All right, what else we got?
Okay, so one question is, what is research after commercial production? Does it mean improvements post-production do not count? Not the case at all. It's really just, hey, QC, we're making Lay's chips and we need to generally QC some of those. Or we're just trying to see if market research likes a new flavor. That would be the non-qualifying portion. But to the extent that you're making improvements to your product, that's absolutely R&D, as long as it meets the 4-part test.
You know, the answer to this poll 4, now we're jumping back to this, only half of the companies have been informed about the capitalization requirements. And I'm not surprised because some of the boutiques have not even brought it up. They're not telling their companies that they have to capitalize, and they're still reducing expenses and taking a lower credit than they have to under the old 280C rules, which Carolyn's going to get into now and talk a bit about 174.
Yes, I am. And I will be brief because as Marty mentioned, we've got a whole section on this. So what you're seeing here is our approach to 174 capitalization. You can see kind of the egg. We start with the 41 expenses, which are much more limited than the section 174 costs. And this information, along with a client interview, whether it's a CFO, VP tax, as well as all of the general ledger detail, is utilized to come up with the 174 capitalization amount. As we all know, it requires capitalization of indirect costs related to research activities. So that could include overhead costs, wages. There is also a lack of guidance around this. So any reasonable method, we always talk about documentation, whatever method you use, make sure you're documenting. So prior to 2022, the 174 vague definition was taxpayer friendly. Subsequent to 2022, it is now punitive, and we'll get into that a little bit more. Something that is related very closely to 174 is 280C election. And what that is it's intended to prevent a taxpayer from taking a 41 research credit and a 174 deduction on the same expenses. So starting in 2022, likely you do not want to elect 280C. There is, go ahead.
You can't, it doesn't apply for the most
It doesn't
part.
apply. And actually the language was changed from research expenses to research expenditures. There is one time, and I've only seen it once, where there is a required 280C adjustment, and that's when the R&D credit exceeds the 174 amortization expense. So,
And you'll only run into that under a year where you're claiming the alternative simplified credit and your expenses are so much higher in the current year than they were in the past years.
limited. All right.
So one thing that's very important to companies is the difference between a refundable and a non-refundable tax credit. So the ERC is refundable. You get cash. The R&D credit, technically speaking, for the most part, for most companies, is non-refundable, meaning it can only be used to offset a tax liability. If you don't have a tax liability, it is not cash back to you, unless you're in your first 5 years as an operation trader business in the first 5 years of generating gross receipts, revenues, essentially. And those gross receipts are $5 million or less. You can monetize beginning in 2023 up to $500,000 of research credit against your payroll taxes. And the way that works is essentially you make the election on your what's known as a Form 6765, and you then have another corresponding filing that goes along with your payroll tax filing, and you get to utilize that credit and begin to burn against it essentially for payroll tax purposes in the quarter subsequent to the quarter in which you filed the 6765, your tax return, essentially for income tax purposes. Some states are monetizable. Sorry, some are refundable, some are monetizable against payroll tax as well. Examples being Georgia and Virginia, two different ways of getting that. The Georgia is monetizable against payroll tax, depending on your gross receipts position. Virginia is a refundable credit, depending on your size. Overall, the credits carry forward for back when you had 20 years. And let's see what the next thing is. This is what I was supposed to talk about on this slide. I already talked about. So here we go. Monetization. The case law thing. This is the last thing I want to talk about. This is a case that just came out. It's a tax court case. Essentially, you had a company that was an S corporation that designed, supply air control systems for large companies. So they would have to make little adjustments or client requested adjustments to these air control systems for large companies. They were approached by a large consultancy. You can read the name right in there. It begins with A. That they were approached by, who did a study for them, didn't sign the tax return, because they never do on their behalf, charged a contingent fee, and did not, the IRS looked at it and said, look, you didn't document basically that you retained any IP. The time record keeping was not, they didn't use our R&D technology tool, nor did they have time tracking to do it, but it wasn't done in a way that tracked it to both what the project was and what the specific activities were. And then there's another rule under 174 that if you're building a pilot model, you can pick up a large amount of the supply prototype costs that go with that, to the extent there is uncertainty with respect to that model that you're building. It was very unclear that these were pilot models whatsoever. And so what they ended up with was a study that showed them about a $500,000 tax credit in 1 year. And that's just one of the years that the study was encompassed, where the CPA relied on it, and it was determined that the taxpayers did not have enough documentation to qualify. Could they have gotten a credit here? Sure, but the documentation would have had to have been better and more specific to exactly what they were trying to claim as pilot models. And one of the things that the IRS looked at with respect to whether or not this credit seemed to be valid was the fact that it was a contingent fee arrangement. And so that ended up having quite a negative effect on the court's view of whether or not this was truly research. And so I would just say avoid contingent fees when it comes to R&D, especially if they're going to get looked at by the IRS. Most of what I've seen in the case law lately is bad documentation. But when I actually see that the fact that it was a contingent fee in there, that's interesting. We have seen some suggestions for changes to the 6765, the form for next year, to provide more detail around what the projects were, who you worked with as a provider, and just beginning in 21 on amended return claims as well. We've seen changes in documentation requirements that require a disclosure statement that goes down. Okay.
Do we have a remaining polling question, Carolyn? Or are we
Yeah.
there?
Have you received any inquiries from the IRS regarding ERC or R&D the past 3 years? Yes, no, I don't know. And we may not have that much more time to get through it because we are 1 minute to go. So let's see. Vivian, were there any other cool questions that we want to hit? Well, anybody's got this?
There were many questions. Is there any chance that section 174 won't be passed? I think this is already passed. Maybe
Yeah.
the person that's asking this.
What they're asking is if it will be repealed.
Right.
All that happened was 174, which has been around since 1955, which gave you the ability to either capitalize or deduct required capitalization. Do we think that may change? Maybe, but I don't think anytime soon. Will it be retroactive to 2022? There's proposals to have that happen, but that would be an absolute administrative compliance nightmare for everybody that works in the accounting industry to go back and refile all those returns. So we don't know
Don't count on it.
what's going to happen. Yeah, we don't know what's going to happen. All right. We are done. Dan, you want to give 30 seconds to the end, and then we'll get through. We'll give our-
So just this is a quick summary of how we approach the work. I covered this a little bit as I was covering the slides. We review your R&D credit if you have it taken in the past on our own nickel and do a very deep dive compared to prior firms. We tried to collect on that here. This is really our investment in our clients and targets, and we do a very deep dive and understand your business before we even proceed to take on the study. So I think that's the gist of it. Reach out to us. All of you who said you haven't taken the R&D credit, or those of you who have heard what we said today and thought maybe you've been at risk for some of the things that your current firm is doing, we're happy to scrub that and look for any areas of opportunity or risk.
Anybody who answered a question, I'll write back to you directly within the next 2 days to what the answer is. Thank you. That concludes the session. If you have any questions, again, reach out to any of us. You have our contact information here. We do value your feedback. Come back to the 174 thing in a half an hour. We'll get more into this. And what we'll do maybe is take some of those questions that are R&D specific and answer some of them on that. So thanks, everybody.